Over the span of 6 weeks, silver moved from historic highs into a collapse severe enough to convince the market that the story was over. Yet at the same time, physical silver prices in Shanghai traded nearly $30 per ounce above New York, a divergence never observed in prior cycles. As paper prices declined, real metal became more expensive. So which market is telling the truth? If history echoes 1979 and 2011, the question is no longer whether silver will rise, but whether a $300 price by the summer of 2026 is already being underestimated. At the exact moment silver charts flash red across trading screens, elsewhere, physical metal is being removed from warehouses. Not through mouse clicks or algorithmic trades, but via forklifts, wooden pallets, and signed delivery manifests. The smell of cold metal, warehouse dust, the sound of steel striking steel. This is where price discovery truly occurs. And it is precisely there that silver's narrative is diverging sharply from the story told by the paper market. The price differential between physical silver in Asia and derivative-based pricing in Western markets is not an abstract statistic. It represents a separation between two fundamentally different systems. One operates on contracts, leverage, and instant liquidity. The other requires tangible metal, metal that must exist, must be transported, and must be delivered. When the distance between these two systems widens, the market ceases to function normally. Structural fractures begin to surface. Anyone who has followed major commodity cycles in the past will recognize this phase. It does not announce itself loudly, it builds quietly. Prices may fall, headlines may turn negative, sentiment may deteriorate. Yet beneath the surface, physical flows do not reverse. Metal does not return to the ground. Demand does not disappear simply because charts turn unfavorable. Silver has remained in this compressed state for an unusually long period. For more than half a century, it has occupied an ambiguous position, not fully recognized as money, yet not treated solely as an industrial input. While gold has been formally acknowledged as a defensive asset and other commodities have been repriced through inflationary cycles, silver has remained suspended between two roles, capturing the full benefit of neither. This prolonged ambiguity has created an extended compression rarely seen in market history. When a structure is compressed for too long, its release is not smooth. It occurs through sudden dislocations, sharp advances, violent corrections, and periods of quiet that cause participants to doubt their own convictions. The last two major silver breakouts shared these characteristics. Crucially, each decisive upward phase was preceded by a shakeout that convinced the majority of participants that the cycle had ended. What distinguishes the current cycle is a fundamentally altered macroeconomic backdrop. Silver is no longer priced primarily by short-term speculative flows originating in Western financial markets. The center of demand has shifted eastward, where silver is not merely traded but actively consumed and accumulated. In this context, silver is not a data point. It is a strategic industrial input and a culturally embedded store of value. Consider the solar supply chain. Silver is embedded into photovoltaic panels, and from that moment forward, the metal effectively exits the tradable market. It does not return to warehouses or exchanges. Each year, increasing quantities of silver are permanently removed from circulation, while new mine supply fails to expand proportionally. This is not a projection. It is an observable supply-demand dynamic that has persisted for years. Parallel to this industrial absorption is the quiet re-emergence of silver in a monetary role. Not through slogans or political rhetoric, but through regulatory frameworks, institutional mechanisms, and legal recognition. When a metal begins to be reassessed as a defensive asset within the financial system, demand ceases to behave linearly. It transforms, shifting from usage-based demand to balance sheet demand. Historically, markets tend to recognize this shift with a delay. It is precisely at this intersection that traditional technical analysis begins to lose explanatory power. Indicators designed for stable regimes are ill-equipped to interpret periods of structural transition. Price corrections in a new regime do not carry the same informational content as corrections in the old one. Yet most participants continue to apply familiar analytical frameworks, largely because those frameworks are deeply ingrained through years of market conditioning. From an observational standpoint, the most revealing signal is not the nominal price of silver, but the market's reaction to information. When prices fall sharply but physical flows remain unchanged, when negative headlines intensify but physical premiums continue to widen, when fear propagates faster than empirical data, this is when market structure begins to diverge from collective psychology. This dynamic cannot be separated from the US dollar. For decades, the relative stability of the global reserve currency obscured a gradual erosion of purchasing power. Monetary and fiscal expansion did not generate immediate shocks, but instead accumulated into long-term asset repricing pressure. Gold reflected this process early. Silver, due to its hybrid role, historically responds later, but with greater magnitude once repricing begins. Within this environment, bond and commodity markets are sending signals that appear asynchronous yet remain deeply interconnected. As long-duration debt instruments lose appeal, capital increasingly migrates toward assets that cannot be created through policy decree. Silver occupies a unique position at this junction, sufficiently small to move violently, yet sufficiently critical to remain systemically relevant. What renders the current cycle particularly strained is the convergence of multiple forces. Industrial demand remains resilient. Silver's monetary function is expanding. The dollar faces structural headwinds. And paper markets are increasingly decoupled from physical reality. Any one of these forces alone may be insufficient to trigger a major repricing. Together, they rarely resolve in a linear fashion. If silver is observed solely through headlines or daily charts, the broader structural transition is easy to miss. Feelings of "it's too late" or "it's already over" tend to emerge precisely when markets are shifting regimes. Commodity history demonstrates that the majority of cycle gains are realized not during periods of comfort, but during periods of doubt. The central issue here is not the assertion of a specific price target, but the identification of a temporal inflection point, a moment when silver no longer behaves as it has over the past 50 years. A moment when legacy metrics generate increasing noise. A moment when physical metal and paper pricing diverge. When these signals appear simultaneously, markets are typically undergoing a cognitive repricing before a numerical one. At this juncture, each observer must ask, am I reacting to short-term volatility, or am I witnessing a long-term structural transition? These two perspectives yield fundamentally different conclusions, even when examining the same chart. This is why the original question has shifted from "Will silver rise?" to "Where are we within a broader monetary cycle?" When paper prices and physical metal communicate conflicting signals, and when geopolitical and economic realities force a reassessment of defensive assets, silver ceases to be a short-term trade. Instead, the market begins redefining how purchasing power is preserved in a high-debt, high-technology world. Viewed through the lens of monetary history, periods of systemic stress consistently follow a pattern. Gold moves first to restore confidence, and silver follows to amplify the signal. This has occurred repeatedly. In the current cycle, technological acceleration, energy transition, and geopolitical fragmentation add new complexity and speed to the process. This may only represent the opening phase. The months ahead will reveal whether the gap between paper and physical markets narrows, and how the financial system responds to sustained structural pressure. We will be monitoring these signals closely. How do you believe this dynamic will reshape the way U.S. investors perceive gold, silver, and high-technology assets? Share your perspective. This is Money Cycles, where we examine the forces and cycles shaping the future. To stay informed on what comes next, you know where to find us. Sometimes, the most important skill is not predicting correctly, but recognizing direction when the cycle begins to turn.